Welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today, September 15th, 2025, we're putting the spotlight on USDCHF, a pair that has seen considerable action and news flow recently. First, let's contextualize the current market environment based on the latest news. The US dollar has generally experienced significant weakness, largely attributed to soft US jobs data and statements from the Federal Reserve hinting at a dovish stance. For instance, the market is pricing in a 25 basis point Fed rate cut, with Deutsche Bank even predicting cuts in September, October, and December of this year, and potentially into 2026. This dovish outlook for the Fed stands in contrast to the Swiss National Bank, which is signaling steady rates, aiming for price stability. This policy divergence naturally provides strength to the Swiss franc, a traditional safe haven currency. Looking at the daily chart for USDCHF, we can clearly observe a persistent downtrend over the past year. Since highs around 0.915 in May 2024, the pair has consistently formed lower highs and lower lows, painting a clear bearish picture for the long term. This aligns perfectly with the narrative of a weakening US dollar and a strengthening Swiss franc. Now, let's zoom into a specific event from late August that highlights how news directly impacts short-term price movements. On August 28, 2025, the USDCHF initially continued its downward momentum, pressing into a key swing area. However, as seen in this one-hour chart, the pair found strong support around the 0.8000 level and subsequently reversed course, climbing steadily. This rally was largely driven by better-than-expected U.S. initial jobless claims and a stronger GDP revision that boosted the dollar broadly for a short period. The resistance target of the 100-hour moving average, noted around 0.80356, became a battleground during this rebound. While impressive, this short-term reversal did not negate the broader downward trend, as the pair soon reverted to more choppy and indecisive action. Returning to our daily chart, we can see the consequences of this underlying bearish sentiment more broadly. The pair has been struggling below the psychological 0.8000 mark for several weeks, oscillating in a tight range. News reports from September 8 highlighted USDCHF languishing near a one-month low, appearing vulnerable below this critical 0.8000 level. Technically, sellers are firmly in control, with prices trading below the confluence of the 20- and 50-day simple moving averages, which currently sit around 0.8019 to 0.8023. This bearish barometer, as described by analysts, suggests any recovery attempts are likely to be selling opportunities unless a significant catalyst emerges. The relative strength index, while bearish, is also flatlined on the daily chart, indicating a period of near-term consolidation. This points towards a market lacking strong conviction in either direction for the moment, but with a clear downward bias. Let's pinpoint the very recent price action on the 15-minute chart to grasp the immediate market mood. Over the last few days, specifically from September 9th to 12th, we observed the USDCHF has indeed been consolidating within a narrow band, roughly between 0.7950 and 0.8000. You can clearly see the repeated attempts to break higher and lower within this tight channel. The price briefly dipped to 0.79383 on September 9th and then 0.79431 on September 11th, but quickly found buyers. However, these minor dips were not sustained breakouts, merely testing the lower boundaries of the current range. This confirms the short-term directionless behavior, but within the context of the larger bearish trend. So, what are the key takeaways for trading USDCHF? For the short term, the pair is expected to remain range-bound between 0.7950 and 0.8000, with a slight bearish tilt. A sustained break below 0.7950 could quickly lead to a test of the crucial 0.7900 support, with the yearly low of 0.7872 as the ultimate downside target. On the flip side, any significant upward movement is likely to face strong resistance at 0.8000, followed by the 20- and 50-day SMAs around 0.8019 to 0.8023. To shift the short-term bias to bullish, we would need to see a clear breakout and sustained close above 0.8071, which looks unlikely under current conditions. Long-term, the outlook remains bearish, reinforced by the dovish Fed and a resilient Swiss franc. We rate the likelihood of testing the yearly low of 0.7872 at a high 70% if upcoming U.S. inflation figures, like the Producer Price Index on Wednesday and Consumer Price Index on Thursday, come in weaker than expected. Conversely, a strong inflation print could spark a relief rally towards 0.8025, but the probability of this reversing the overall trend is low, perhaps 30%. Keep a close eye on these economic data releases, as they will provide the next significant impetus for USDCHF, determining whether it extends its bearish journey or finds temporary reprieve. Remember, trading leveraged products carries substantial risk, so always conduct your own thorough research. Don't forget to like, share, and subscribe to Explain the Charts for more in-depth market analysis.